Good morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the pre-market webinar series. Before we get started, please take a look at the shared disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, is for informational purposes only concerning Market Chameleon tools and products. With that, D, good Wednesday morning, my friend.
Good morning, Will. How are you?
Good.
Good morning, everyone. I am going to share my screen here, and today we will cover the long call option screener. Yesterday we did the covered call. Today we're going to do the long call option screener. So this is just looking at it from the side of buying a call option, and no stock involved. And the outlook there is that you want the option to appreciate in value if you're buying the call. So we're going to take a look at the screener, cover some of the analytics to help us narrow down potential candidates, and take any questions. So let's start first by showing you how to get to the screener. And if you look at the above menu, you'll see under screeners to the right-hand side, there are these single leg strategies. And we did the covered calls yesterday. I'm going to go to the long calls right here. So if you click on the long calls, you're going to end up on this page over here. Up top, we got these filters with different tabs. And then below, we have a table with data, information, analytics for different long call candidates. Okay. We also have multiple tabs of data and analytics. Let's start out with this summary page over here. And what you'll notice is if we go from left to right, here it lets us know the stock symbol, which in this case is Apple, AAPL, Apple stock price, the change of the stock on the day, and its market cap. This here is sorted right now by default using the market cap column. So that's why you see a lot of Apple candidates here. Over here, you see that these are different strikes. So when we look at calls, Apple has many different calls, call options. There are different strikes. You have different expirations with different strikes. So it's not just one call to analyze. There are lots of different calls for each stock that we could analyze. And this allows you to do it in a screener. By default, we have the expiration over here on the filter set to the next monthly. So here we have December 20th expiration. This is why on this column you see December 20th. You can change that. You could click on that filter. You could select a specific expiration, or you could assign it a range of days you want to cover, and it will retrieve the expirations that are fit into that range. So if you say next 14 days, next 7 days, next 30 days, you'll look for expirations that cover within that date range. Let's stay on December 20th for now in our example. So these are the stock details. Here we have some of the analytics that correspond to the long call we're analyzing. So in this situation, if we go to the long call, we see that it's a December 20th, 255 strike call. And that call has a 10 delta. Okay, so it's an out of the money call. The delta lets us know the price sensitivity of the option according to the Black-Scholes model for a dollar move in the stock up or down. So 10 delta means that this option is expected to increase by 10 cents if the stock goes up by $1, or expected to decrease by 10 cents if the stock goes down $1. That's its directional risk for dollar move, according to Black-Scholes model. So let's come over here and look at some of the other analytics to help us narrow things down, analyze it, give us a sense of like how expensive this option is, how cheap is it, how much is it in line with historical benchmarks. That's when we try to evaluate something and its price, we need some kind of model and benchmarks to help us get a sense of, you know, where is this price, the market price, relative to some kind of model, you know, pricing model, valuation model, or using benchmarks. Okay, that's, you know, in any financial risk asset that you're evaluating, you're going to try to use a model. So there's no one right model. You could, and there's, you know, and each model also can have different inputs and assumptions. You know, you could use different data sets, you know, 1 year, 2 year, 5 year, whatever you do. But we're going to start out with a base model, and you could work from there. So here, first we look at the price of the option, and it says that this option right now is 44 cents. Okay, since this is a long call screener, when we look at an option, it has a bid and an offer, right? So the option, the market price is anywhere between the bid and the offer, right? And since we're evaluating from the long call, from buying it, we're referencing the offer because we know that that's the price that's firm that you could purchase it at. Of course, you could potentially get a better price. You could try to buy it in between. You could try to buy a little bit below the offer. You could try to, you know, put in order to make your executions more efficient. And as a trader, you should be doing that. But for valuation purposes, we're going to start out by looking at the ask price, where people are willing to display a firm offer where they're willing to sell it, and you know that you could go and buy it. Okay, so that's the market price we're looking at, is the ask price, 44 cents. Okay, well, I don't know if that is expensive, if that's relatively cheap. You know, I need a little bit more information, right? That maybe that's completely out of range and it's indicating people are too bullish on it. Maybe it's very low and people are kind of bearish on that option. So we don't know the outcome, but let's take a look at, you know, because the outcome of that option is really going to depend on what the stock does between now and expiration, you know, and what buyers and sellers and the options are going to do. But we don't know that, right? Because anything could happen. Markets are dynamic. You know, news is dynamic. You know, there's a lot of uncertainty. So we don't know the outcome of, you know, what's going to happen between now and expiration in the stock or in the option. But let's take a look at, you know, from the perspective of what do we think our risk is and potential reward. So looking at 44 cents, is that a, you know, crazy price, or does that seem like a pretty, you know, low price relative to history? Because if the lower you could purchase something, the less risk it is, right? Because you're paying less money for it. And the lower you purchase it, not only the less risk, well, the higher the potential return is, because the less, you know, the higher you pay, you know, it has to go higher than that. The lower you pay, and if it goes higher, there's more potential reward as well. So let's take a look at that and try to use some kind of base model to get a sense of where does this option, how does this option look like? So this theoretical value over here, see, we got Theo value, Theo edge, win rate, probability touch, and then the analysis used if you open it, if you click open, it'll show you the analysis used in this particular model. So it is based on Apple's historical price return distribution. Basically, how did Apple behave historically using similar circumstances? So using, how many days are left to expiration? How far away is this strike relative to the stock price? How often did, Apple increase by enough to cover the cost of it? How often did it just stay the same, go lower, didn't go up enough? So we're looking at history and trying to assess, Apple's liquidity, historical stock behavior to see, if this is a realistic price, if it's on the low end, high end, on its historical average. So using that model, looking back in history, and I think you could actually change this model with some of these available filters. So this is looking at 4 years of history. We could actually rerun the model right from here by changing the number of years. But let's stay on the 4 years. This is 4 years of history. And it says that using 4 years of history, on average, this option would be worth $1.65, right? Meaning that there are times that it went up by a big enough percentage, that the average, was $1.65. So looking at that, 44 cents doesn't look that unreasonable, right? Not that it doesn't look that high, it looks pretty far away from the average. Now, of course, the average could also be skewed because you had like this big outlier out there that may not happen again. Maybe it announced news, so it could be something that really skewed the average up, and we need to know more information, right? So and before we get to that, this here, the edge, shows you, in theory, if we did use this $1.65 as the average, if we accepted that is a long-term average price, and the distribution looks anything similar in the future that it did in the past, well, if we took the difference between the market price and that average price and put it in terms of percentage, this would be a 275% theoretical edge, right? Because you can see here, this option has to go up by a lot, more than double, so it's a pretty, so far, big discount. Now, keep in mind, of course, you still have to have that outlook that you're bullish, right? If you're using a long call screener, you have to have that outlook that you're bullish on Apple, because that's the way, right, the calls work. So now that we've seen that, what about a little bit more information? Well, if we use that 44 cents, let's say we did use this 44 cents, and we're curious in our database, based on how the stock moved, right? Looking at all our observations, how often did the stock move up enough? Because obviously the stock needs to go up, right? From 242.69, it has to go above 255. Plus it has to cover whatever we pay for this option, 44 cents. So it's got to go up, but above 255.44, right? $255 plus the 44 cents we paid. The stock has to be above that at expiration. So if we look at that from 242.69, we could figure out, well, what's that percentage move equal to, right? We could figure out the percentage move. And then we could go back in history and say, well, how often did Apple increase by that amount, right, to cover the cost of that option and be profitable? So that is here, over here, the win rate. That says 19.4%. So you could see it's not frequent. It's not like lots of time, it's not 99%. Yeah, it doesn't happen that frequently, but it doesn't happen infrequently either. Almost 20% of the historical observations, it's done that. So it's not even that infrequent. And actually, it happens more frequent if we just use the delta as our, kind of implied probability, which isn't exact, but that the delta is implying a 10 versus a 19 here. So you could see why it's discounted, right? So historically, it's happened more frequently than the current markets are implying. That's why this option here looks like it's discounted. Okay, the markets are giving it a lower probability right now. That's what's happening. The markets are saying we're having a lower probability, and maybe it's justified. Maybe in December, we'd have to go maybe massage the data a little bit, because maybe in December just things happen to be a little bit more muted, less news that comes out because of the holidays, maybe there's not as many conferences. We could go and look at that, but we're using the base model right now. Okay, so looking at that, it looks like it is on the lower end. So this win rate, that looks at the historical win rate based on the holding that option from the starting point to expiration, given this same date range. So how many days are left, whatever trading days are left between now and December 20th, that's what it's looking at. But the stock itself, right, it doesn't, close and not trade anything in between and then just reopen at a new price like that, right? So whatever here, we could open our analysis here. So this is saying that there are 13 days, trading days left, right? 13 trading days left. Well, if there are 13 trading days, that means the stock can move around up and down, and it doesn't finish on the high or low. It could be in between. It could have volatility. So we have this other column here, and we'll call it the probability of touch, meaning at any given point historically, you have 13 trading days. So we already measured, the two reference points, start to finish. Well, but another question is, how often at any point in between did the stock go up enough to make this call profitable, right? So it could have gone up and back down historically. So how often did it go at any point in between those 13 days, right? So then we were measuring from the starting point to the high of the stock in those 13-day buckets. Well, that happened 35.5% of the time. So you could see this would be higher, right? If it did it at least 19%, it could be even more if we measure everything in between. So that's what this is, 35.5%. So it's not, so you could see it's not high, but it's not that crazy either, that it's still more than a third of the time, right, in our historical observations that this occurred, to cover this 44 cents. Okay. Moving along, now that we kind of understand this, and if we wanted to see the breakdown of it, we could come over here. This explains to you, how we came up with that 44 cents, right? This tells you the strategy. This tells you we used 4 years of data, 13-day hold periods. We took out any earnings periods because if between now and expiration, Apple's not expected to report earnings. Well, we're going to take those out historically because that's an event where the stock is more volatile. We know that. Let's exclude that so we could line up the data a little bit more in line with what the situation or circumstances we're analyzing. So given that, you could see there's 31 observations, and this lets us know, well, for the stock, if it doesn't increase by 5.1% between now and expiration, this call is going to be worthless, right? We know it's the stock's going to be below the strike, and the call is worthless. That happened over here 74% of the time. That means this will be zero. If it happens anywhere between the break, in between where it's above the strike price but below the average, that's over here 6%, 16 cents. And then if it goes above, how many times that happened? 19% of the time, $8. It was worth $8.47. So multiplying the percentage times the average return, you get $1.65. Okay, and these are the observations below. So let me close it. Another analytic we could look at is just what is the implied volatility of that option. So this is telling us it's 16.2. And what did the implied volatility do in a day? Was it up or down? Because if it's down, it's indicating there more selling pressure, more demand on the sell side. If it's up, it's indicating more demand on the buy side on a relative basis. So this is telling us it was down 3.3%. Okay, so on a relative basis, there's pressure on that ask side. There's some here technical indicators to give us an idea what the stock kind of has been doing recently from a technical perspective. So these are using moving averages. So if the moving averages look like, they're very bullish, we'll put it there. If bearish, if there's no real technical indicator hitting, it'll just stay blank. So with Apple, there's nothing there that hit those conditions. Then we look at it just on the day. What does the stock look like it's doing on a day? And here it measures it based on its daily support and resistance level based on its volatility. So if it's trading above its volatility band, we'll say it's above its resistance. If it's below its volatility band, it's below its support. If it's within its implied volatility, if it's within its volatility band on the trading day, it will stay blank, right? So for example, NVIDIA was up 1.2% yesterday, but it's traded within its expected standard deviation up and down, right? So within its volatility band. It didn't break out either way, okay? Apple did break out above its volatility band yesterday. That's why it says above resistance. So moving to the next two columns, another analytic we might want to see is what is the liquidity of this option? Okay, we're analyzing the price, but what is the liquidity? How much volume are we trading here? Because if it's zero volume, it could be very low liquidity, and then you have to question, about price discovery or the execution costs and so forth. So here is showing the volume, the option volume in this contract. So Apple December 20th, 255 call yesterday traded 3,180 contracts. Keep in mind, we're not open yet. This is pre-market, so this is looking at yesterday's data. So that's the option volume in this particular contract, option contract. If we're looking for relative volume, well, is that maybe we might be looking for a lot of volume in a particular contract on a relative basis. We could take the average daily volume in Apple's options. It could be 3,000, could be 1,000,000, could be 100,000. What's on average if we took all the option volume on a daily basis, right? That's looking at all calls, all puts, just took it all, and then we took the volume traded in this contract divided by the average daily volume. What do we get? So here you see it's 0.4%. Now, of course, Apple trades a lot of options. It has a lot of volume. It has a lot of different strikes, different expirations. So you could see here on a relative basis, it's not a huge amount, it's less than 0.5%. But you have this column just kind of as a reference, to show if something popped up very high, maybe then it would indicate that this particular option, something might be going on. Why is it, stand out so much? Like, why is 50% of the volume all of a sudden in one call option? Maybe that's worth looking further into it. So you have these now different columns that we could use to sort or to filter by to keep narrowing down the potential candidates. Now, we have also other data elements and filters to consider, but I'm going to stop there for today, just so we could, kind of consume that information. Then we'll move on and try to use some of the filters tomorrow, and look at some more of the data and analytics to help you along the way to keep narrowing down potential candidates to research.
Awesome, D. Great job. That was super interesting. Everyone is super thankful for your hard work and the webinar series. Everyone have a great trading day. We're about to hit the opening bell. Be safe out there. Thanks, D.
Yep. Thanks, everyone. Stay safe out there. Have a great trading day, and hope to see you guys tomorrow.
Trade in peace, chameleons. Bye.